Did you know investing is not just putting money into an IRA or a Roth IRA? Once the money is in that account, you then have to take it and invest it. And this is a devastating mistake for a lot of people who dump money into an IRA or a Roth or a brokerage account. And without investing it, the money's basically just sitting there. Once you transfer the money in, then you have to invest it. Keep watching to learn the most common investing mistakes. Here's a helpful graphic to depict big picture investing through a brokerage. I use Charles Schwab, Vanguard, and Fidelity as my examples. And these are companies where you can open up a tax advantaged account like an IRA or a Roth IRA and invest in it. With a Roth IRA or an IRA, you can basically invest in anything. So this could be mutual funds, index funds, a specific fund like the S&P 500, a target date index fund, or a combination of all of that. It's good to have a plan and a balanced, diversified portfolio and not just picking stocks and funds that you are familiar with, because this is another huge investing mistake that I see. If you think to yourself, I don't recognize any of this, so I'm not going to invest in it at all, but over here, I do recognize some of these brands, so I am going to invest in that. It's a mistake. You need to pause investing, learn and understand all of your options, and then have a plan moving forward. So inside of those funds that I mentioned, then we have stocks and bonds. So some of these could be Nike, Microsoft, Coca-Cola, Verizon. To clarify, this is different from a 401k. With a 401k, typically you have standard plans that you can choose from. So once you choose your plan and the percentage, they will automatically deduct that from your paycheck and invest it. Chances are, if you're watching this video right now, you are not subscribed to my channel because only 23% of the people that watch my videos are subscribed. I would absolutely love it if you took a moment to hit that subscribe button and support me as I continue to create content. Another crucial piece of information when it comes to investing is paying attention to the expense ratio. What is an expense ratio? A boiled down definition is a percentage of the fund's total assets that are going to be used to cover expenses. High expense ratios are bad for investors, which is you. And by high, I mean 1%. This is where people make a huge mistake. They look and they see that their expense ratio is 1% and they don't think that that's a big deal. If this is you, you might be confused thinking, just 1% is not high, like you need to calm down. Here's a real life example so that you can see the impact that a 1% fee has on an investment. If you had an investment of $1 million in a mutual fund being actively invested and the expense ratio is 1%, that fee would equal $10,000 each year. But it gets worse. Not only are you losing out on that $10,000 each year, but you're losing out on the interest that $10,000 would have generated. So times all of that by 10 years, and you've just lost hundreds of thousands of dollars. Here's a smaller example. Let's say it's early on and your portfolio holds $5,000. A low expense ratio of 0.14% would be a fee of $7. However, a 1% expense ratio would be $50. This isn't huge, right? You can see the difference, but we can't do the compounding math in our head with such small numbers like this. Let's say your investment grows to $100,000. If the investment has a 0.14% expense ratio, the fee would be $140. Or with a 1% expense ratio, it would be $1,000. That's quite a bit different. And remember, you're not just losing out on that $1,000 each year, you're losing out on the interest that $1,000 would have generated. You can see the stark difference at the bottom again with the $1 million investment. Compounding interest messes up the straightforward math that we are used to. It turns 1% into hundreds of thousands of dollars lost over the lifetime of an investment. That 1% matters. Anything over 0.7% I would consider to be very, very high and very, very expensive for you as the investor. You want to pay attention to this and really go for those low expense ratios. Anything lower than 0.2% is going to be ideal. Obviously, the lower, the better. Keep in mind, if you're working with an advisor, there could be other fees other than just the expense ratio. So make sure that you're well versed on these fees and you know how much they are costing you. The fourth big mistake that I want you to avoid is focusing on the individual share price of a stock or fund. This is so tough because our common sense wants to kick in, just like with the expense ratio, and say 1%, who cares? That's a tiny fee. Same thing with share price. If we see a small share price, we might think to ourselves, wow, this company maybe isn't doing very well, or hey, what a deal. Or if we see a big share price, maybe we're thinking, wow, this company is really killing it. Look at how expensive this is. And that's just not really how it works. The price of an individual share is pretty irrelevant unless you are comparing the share to itself over time. In order to compare it to anything else, you have to know the size of those shares and then also how many shares there are. And then you got to do a lot of math. It's very difficult to compare shares to each other. There's a lot of steps involved. It's not just apples to apples. So remember, you can't draw conclusions and compare shares unless you look at all of the data. Investing mistakes to avoid summed up. Number one, don't just dump money into an IRA or Roth IRA. You have to then invest it. Number two, don't only invest in brands and funds that you recognize. Make sure you learn and understand all of your options. Number three, an expense ratio of 1% is very expensive. And number four, a single share price doesn't really tell you anything about the company or the fund. Let me know below, what other investing mistakes would you add to the list?